I would like to explain more about this concept of PE and future PE of 102 on the particular example. So suppose we are looking for the company and we would like to buy a really great business and we would like to buy it cheap. But unfortunately, if we go on the market and or we run particular screeners, we wouldn't find the ordinary business because their PE ratio would be high, like 15 or 20 or 30. When we have the coincidence, like the combination of events, for example, when the management will be changed in some time, or when the particular event occurs, like the decrease in some metrics, or unexpected situation, or downturns in the economy, this particular company can go down in price. So the stock of this company, and instead of P of 60, there will can be the P of 15 or 12 or 20. And in this case, we can just combine the price chart of this particular company with the P historical P ratios of this industry and this particular company. And we can actually find that probably in some periods of history, when the company also had P of 20, the revenue was much less and the net income was much less. And this can be one of the indicators that clearly shows that now the company is undervalued, even though it has lower PE and some negative events occurred, but it still has higher revenues, higher net income, less debt, and all these different indicators, which we'll discuss later. What do you think about that, Nick?
So this is a unique method to me. I've not heard of it before. It makes a lot of sense if you're seeing a drastic drop in PE, and that PE new number is the same as a previous number in the company's history, and yet now the income and revenues are far more than when it was previous. It does indicate that you might be looking at a great deal. This is a interesting new angle I'm going to have to look into.
Yeah, and when you can just understand that you can buy the company, and for most people it can be overpriced with a particular PE ratio, but you can actually invest and you can wait for the returning of this particular PE for a certain period of time. Of course, the PE can fluctuate because the revenue can increase, the price can drop, etc., etc. Plus, you need to consider different combinations of other factors. You can actually receive the same um, percentages, and you can increase your money like 50 or something percent. And this is what is called the PE of 1 or 2. So when you can double your money in 2 years. So for you, this is the PE of 1, even though for other investors it is not.
Yeah, very interesting. I find that keeping in mind when investing that everyone has a different method. So the more investors you become familiar with their checkpoint items, the better, because it expands your own checklist. So this is why we analyze other people's checklists, and I get a lot out of it. So here we're listening to Eugene's, and I'm like, I've never heard of that one before. So it's a huge benefit. And with regards to this particular point, PE is price to earnings ratio, and all it really is saying is a combination of, so the price is determined by the consumer's excitement about the stock, or the opposite. The price to earnings is showing how much are you paying for the earnings that you're getting, and that's what the ratio is all about. So when you see a very big jump down in price to earnings, you're just seeing consumer confidence going down in that company, but you're still getting the same earnings potentially as what you were before. And so it's more of a deal. Very interesting.
Yeah, and this brings us to the next point in the checklist, which is the debt, the analysis of the debt, and understanding whether the company has low debt or zero debt at all. And I think this is really important because we do not know what will happen in the next year or several years. Probably the economy can go up or down, or maybe it can be the recession. We do not know. And we need to be protected from the unexpected situation from the financial point of view in the company. And usually when the company has a lot of debt, it will be harder for managing it. And when the revenue decrease or the management can change or something unexpected can happen, this can really affect the price of the company.
Yeah, so debt is a very good one. It should be on everyone's checklist. How you analyze the debt will be different from investor to investor. Um, so some people will look at the debt to equities ratio. Some will look at the debt to free cash flow ratio. But essentially, you want to know that if times get hard, the company will be able to meet its obligations and easily. You don't want them to be struggling or do bankruptcy or something like that. So it's important to know that that the company itself has a margin of safety with regards to its debt.
And the next point of the checklist is to understand what are the risk and the returns. So in this case, I usually prefer to choose the companies with low risk and high uncertainty. It is the classical papaya approach. So it's like the heads I win, tails I don't lose much. And I try to really think what can happen in the most negative scenario of the business that I will be with zero gains, but I will not lose the money at all. There are rare situations, but they actually occur when you can benefit a little in one negative situation, and you can receive a huge benefit from the unexpected and unclear situations if the probability will play out. What do you think about that, Nick?
I like this one a lot. Thinking about your company in various situations, knowing that it will survive that situation and maybe even thrive because of that situation. Some companies are what's called anti-fragile. And anti-fragile doesn't mean a fragile thing breaks when you hit it. A really hard thing can withstand it. But anti-fragile almost means that the opposite of fragile doesn't just mean hard. The opposite of fragile means that instead of breaking easily in a bad situation, maybe it even improves in a bad situation. And so, for example, if you've got a restaurant that is, let's say like Chipotle, they're a premium fast food restaurant. So if a inflationary period happens or a depression, people will stop eating at really expensive restaurants, but will they stop eating at Chipotle? Maybe not. Possibly they will eat instead of going to an expensive restaurant, they'll go to Chipotle. So Chipotle might even benefit in bad times. And so you're looking for companies that they can handle. Are people going to stop buying lipstick when a depression happens? No, they won't. Or chewing gum or Coca-Cola. So some companies are anti-fragile, and so that lowers your risk in those situations for those companies.
And this brings us to the next point, is to understand whether the company grew and continue to grow over the last 10, 20, 30 years. And by then, I don't mean to invest in the growth companies. This can be the company with the 100 billion in market cap. It's like the special DNA of the business to grow, first of all, and if the business model is really great, it will continue to grow even if the market cap exceeds the certain amount of level. And second of all, revenue and the growth is really hard to fake. So it's almost impossible to fake the revenue unless you do something illegal, which we all know the CEO and the top management can go to jail in the US and in most European countries. But it's really hard to fake. And we can consider these numbers and we can understand that if we purchase the particular company at this price, and even if it's fair or little overvalued, we will still receive the benefit because the company is growing. It's always better to find the companies which continue moving forward and increase and buy competitors, develop everything, etc., in comparison to that companies who are stable. What do you think about that, Nick?
It reminds me of a question that was asked recently that I thought was one of the best questions I've seen. And that is, why is it that on average, the stock market, for the entire history of the stock market, has moved upwards? Why is it that good companies always move upwards? Is there not a limit to growth? And what causes this constant moving upwards? And there's a lot of answers to it. One of the answers, of course, for the market as a whole is bad companies go out of business and good companies tend to grow. So on the whole, you'll have the market going upwards, but that's not really the entire answer. To bring it more to your point, a wonderful company will have it moving upwards because of increased efficiencies, expanding into new markets. For example, maybe 40% of the planet or even 50% of the planet has never been online. And so as those companies come on, as those countries come online, the marketplace expands for those kinds of services and also all the other services. So your company might only have been in America for the last 30 years, and now they're moving into Europe or they're moving into Mexico. So there's an expansion of market. And also a good company will expand its product line, or they'll get into a whole new industry, spawning into it and disrupting existing people. So, maybe Google will buy YouTube, or Facebook will buy Instagram, and thereby start expanding in more lateral directions. So, a good company will lower its costs. It'll find ways of increasing the value per customer. It'll increase its prices with the price of inflation, and perhaps beyond. And as they increase prices, so does the revenue increase, and therefore people will pay more for the company. And so, for all these reasons, the profits go up, the revenue goes up, and your stock price will go up.
Yeah, definitely agree. And the next point, which is closely connected to the previous one about the growth, understanding whether the business and how much additional capital will the business require in order to grow. Because we all know that in order to increase the revenues and net income fast, you can either issue more stocks or take more debt or reinvest the net income which you have. And usually the great businesses are low capital intensive. There is not, I'm not talking about the software development and all these IT businesses, even though they have this in common. But the same can actually be in the real estate or in the construction as well. So, for example, when you build the real estate object like 2 or 3 years ago, and you paid the price for the lumber and all other materials in previous dollars, and now the prices increased, and you actually can also increase the rent price and increase the net income. So in this case, you already spent this money and you spent less of them in comparison to today. And I try also to look for such companies which are not required to spend a lot of on capex. Of course, there are different examples and different situations, but for me, this is also one of the indicators that the business is great and it will grow by itself for the long period of time. And you will probably not receive the dilution of the shares, or even you will see the buyback of the shares, and you will see that decreasing of the net debt of the company, which will eventually bring the stock up in price.
I like this one a lot. In fact, I think we'll expand this particular point, capital expenditure, into a whole episode in the future, because capital expenditure is divided between maintenance and growth. And sometimes it's hard to tell the difference, but the numbers are very important when you do your investing. So we'll talk about that in detail in the future. Just some small points is it's very interesting to look at companies that are really putting the money into development. Some companies don't need it as much, but like, for example, what does the future of Facebook hold? They've been putting all of their profits into the metaverse, and I believe they've spent something like $40 billion over the last 3 or 4 years developing this out, and they seem to be increasing the amount every year that they spend. So it's fascinating to see such huge investment. It could be one of the biggest and best investments, depending on the future. And then similarly with Netflix, they're putting all their fresh free cash flow into creating new content. and some would argue that it's that they're spending too much on it. Some would say it's a very smart move. So there's much to be discussed on this topic of what are they spending, where are they getting the money from, and how are they using it. And then for startups and early stage companies, uh, they call this burn rate, and you want to make sure that the money they're burning isn't happening too quickly for them to run out of money or needing to borrow huge amounts more. So it's definitely these are definitely figures to look at and analyze and see if they're doing a good job of where they're getting the money, how they're paying it back, are they diluting the shares too much. So this is a very good point to be analyzing.
This is the end of this episode, guys. We will continue next time. And if you have any questions, please write them down in the comments below. And see you next episode.